The S&P 500 is currently near all-time highs, but there's still value to be had in the market. And by value, I mean a low PE ratio compared to a stock's own 5-year average, or a high dividend yield compared to the 5-year average. The first undervalued stock we have is Zoetis, which is the largest animal pharma company in the world by revenue. Zoetis is currently trading at a forward PE ratio of 23.8, which is a 25% discount compared to their own 5-year average of 31.9. Better still, their dividend yield is currently at a 5-year high of 1.3%. Not only is Zoetis cheap, their fundamentals are also growing, with a 10-year annualized revenue growth rate of 6.9% and a phenomenal free cash flow growth rate of 19.1%. This video isn't going to be a comprehensive analysis, but rather give you all some options for your own further analysis. The next stock we have is Canadian National Railway, and you could probably guess what they do based on their name. They're Canada's largest railway network by track length. CNI is trading at a forward PE ratio of just 16.8, which is roughly a 5-year low, while their dividend yield is at a 5-year high of 2.7%, which is 39% above their 5-year average of 2.0%. In terms of their fundamentals, their revenue has grown slowly but consistently at a 10-year annualized growth rate of 3.0%, while their free cash flow per share has grown substantially faster at a 10-year annualized growth rate of 5.0%, which is a function of their meaningful share count reduction, which we see here on the left, and the difference between absolute revenue and a per share metric like free cash flow per share. The next company we have is FactSet, which is a well-established data provider for financial markets. They're trading at a forward PE of 21.3, which is a 24% discount compared to their own 5-year average PE of 28. Their dividend yield is also at a 5-year value, at a high of 1.2%, which is quite low but indicates relative value nonetheless. In terms of revenue growth, they have quite the consistent business, with revenue growth each year for the past 44 years, and an annualized 10-year growth rate of 8.1%, while their free cash flow per share has also been quite consistent and fast growing, at a 10-year annualized growth rate of 9.1%. Also, FactSet seems like a business that is well suited for the current tariff environment, given that they are a software business and aren't moving goods across borders. The next cheap stock we have is Constellation Brands, which is a popular adult beverage brand. Constellation is trading at an ultra-low forward PE ratio of just 13, which is 35% below their own 5-year average PE of 20, while their dividend yield is also at a 5-year value at a high of 2.4%, which is significantly above their 5-year average yield of 1.4%. The revenue has grown each year since 2016, giving them a 10-year annualized growth rate of 4.5%. Lastly, we see their free cash flow per share has grown at a stellar pace, with a 10-year annualized growth rate of 14.9%. This free cash flow growth rate might be one of the main reasons why Warren Buffett's Berkshire Hathaway owns a $2.2 billion stake in Constellation Brands. The last stock of the undervalued group is General Mills, which is a domestic food company. GIS is currently valued at a forward PE ratio of just 13.8, which is near a 5-year low, while their 5-year average PE is also fairly low at 16.2. But what makes General Mills particularly enticing is their dividend yield, currently at 4.9%, while their average yield is far lower at 3.4%. And this doesn't look to be a yield trap either, considering their free cash flow payout ratio is only 58%, although their yield is likely so high partly because their revenue has grown so slowly, at a 10-year annualized growth rate of just 1.6%, while their free cash flow per share has grown slightly faster at an annualized growth rate of 2.0%. If you'd like to see a full analysis on General Mills, check out this video, or if you want to see my trades on Patreon, the link is in the description.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.